Good afternoon, everyone. My name is David Scherer. I'm co-CEO, co-founder, Origin Investments. We have an awful lot of attendees today, and thank you for your time. I'm going to jump right in. I'm going to give a brief remarks, and then I'm going to introduce my esteemed guest. In a moment, he'll give some remarks, and then we'll jump right in. I guess my big point, Origin Investments, if you're an investment partner, thank you. And we've been doing this for quite a while, almost 2 decades now. So we've seen a lot of different environments, investing environments, world environments, even national policy. I would say that right now the rate of change and flux, both on a geopolitical level, tariff and trade level, what's happening with AI and the good and potential disruptions of the labor force, et cetera. Like, it's almost unprecedented how much change is happening. So I think this is a very appropriate discussion, and I'm going to try to interject, my data and anecdotes, but we also have a true expert here on this stuff. So I also want to say, as much as things change, and what I mean by that is all of this is true, what I said, but it exists within the context of we still are a country with growing population and we're still massively underhoused, and that hasn't changed. And in a lot of ways, it's actually gotten quite a bit worse over the last 3 or 4 years, because there hasn't been enough capital formation to produce new developments and new housing into the future. And we'll talk about that a lot. But I'm very bullish on multifamily real estate. This, I want to call it noise. I think that understates. These are very serious things. And I'm not suggesting they're not, but I don't think it changes the long-term demand drivers of what we're doing. So those are kind of my thoughts, if you will. I want to also, I want to introduce Robert. So Dr. Robert Dietz is the chief economist for the National Association of Home Builders. His responsibilities include forecasting, industry surveys, policy research. He leads a team of about 12 economists analyzing residential construction and the construction sector. He's been on CNBC quite a bit, Wall Street Journal, NPR, and he's worked also as an economist for the Congressional Joint Committee on Taxation. He earned his Ph.D. in economics from the Ohio State University. Robert, I really enjoyed our pre-call and what we covered, and you impressed me, and I think you're going to impress people today as well. So why don't you lead off, and then we'll jump into the discussion.
Yeah, no, thank you. It's good to join you today. Our view at NAHB is very similar. The broader housing market has essentially been underbuilt over the last 10 to 15 years, particularly in the period after the Great Recession. Our focus at the home builders is in terms of the economics of the supply side. So when we look at the reasons for the underbuilding, which, by the way, affect both single family and multifamily, we've identified roughly 5 causes that have resulted in a housing deficit of probably about 1 million structures. And those 5 underbuild reasons are a lack of labor, a lack of lots, a lack of lending into the real estate construction development space, issues around lumber and building materials, and then legal and regulatory burdens that have made it more expensive to build. So collectively, we call those the 5 L's. Looking at the demand side of the market, as you said, we're in this kind of moment of a lot of change. I think the forecast and the economic outcomes of 2025 have caught a lot of observers by surprise, some not so much, but mostly it's the ongoing persistent elevated mortgage interest rates that have moved a lot of potential home buyers to the sidelines. So the consequences of that is that rental demand is doing better than we expected at the start of the year. And then we have these structural factors on the demographics, including people attaining home ownership later in life, getting married later in life, and all of that is creating a rather positive view on the multifamily rental side of the market, even as it takes a toll on the single family side. And then you put that all into a context of an economy whose labor market is fairly solid. I guess there were some discussions about recession concerns, but a lot of that was really connected to the tariff discussion. But these broad regional trends, including population growth and job growth in areas like the Mountain States, the Sun Belt, are continuing to drive the need for additional residential construction development. And you've got a pretty good runway for developers going forward. So, there's a lot of uncertainty right now, but the fundamentals of the U.S. economy are fairly positive for real estate development as we move forward.
Thank you for that. I think we should jump right in. And I'm looking forward to the conversation because it really was quite vibrant. And we generally agree, but we don't agree on everything. And that's good. I think the format, I'll ask you questions and maybe I'll add anecdotes when appropriate. But I think, for the viewership, you hear me a lot. And, we have Robert here today, and I think he should do most of the talking. So let's jump right in. And I'm going to ask two questions, and it's kind of in the same grouping, but I want to hear your opinion on this. And importantly, I'm sure our investment partners do. And we projected outsized rent growth in the Southeast and Sun Belt in multifamily, in particular Class A assets. That's what we're in. That's what we invest in. That's what we lend to. That's what we develop. Do you agree that these regions still hold the strongest fundamentals into the future? And are there any markets that surprised you thus far this year? I think I'll just stop with that because that's a lot.
Yeah, I think that's generally been our view. Last year was a tough year, of course, for real estate development. Multifamily starts were down 25%. The supply pipeline looked large, right? If you go back to the end of 2023, there were 1 million apartments that were under construction. That was the highest number since the early 70s. But it was a reflection of what had been an outsized trend of population growth. Some of that, of course, connected to the border issues. But if you combine that with some of the regional trends, which is the areas of the country that are growing the most rapidly, and I visit real estate markets every single week. This week I'm going to Iowa. I feel like I've spent a lot of time in Florida in the last few weeks. It's just remarkable, the population growth rates over the last 10 to 15 years. And we think those trends will continue. So the leaders have been places like Florida and Texas in terms of the large markets. You've got smaller markets that are really rapidly growing, and it should continue in a lot of the mountain states. And yes, some of the sales data, particularly single family sales data, has slowed at the start of the year due to rising inventory levels. But a lot of that is due to housing affordability constraints. And you kind of keep in the back of your mind the fact that single family home prices in some of these markets have increased since COVID 50 or 60%, which is way outpacing income growth. So all of that would suggest that as long as the labor markets in these areas continue to expand, and that's certainly what people on the ground are planning for, you're going to see nice solid rent growth and eventually a rebound in some of the home buying activity, which admittedly has slowed here at the start of the year.
Yeah, so homeownership is simply out of reach for a lot of people. It's high interest rates paired with high costs of the home. The payments are too high. And in addition, not everybody has $50 or $75 or $100,000 to put down in addition to that. And so it's very difficult. And so within that frame, I see that as one issue. Do you think that will persist? I guess that's the question in this is it has persisted for the last 3 years. I've been very surprised at the resilience of the for sale market. I understand a lot of people have low interest rate mortgages. I understand that, they're quote trapped in their homes, et cetera. But over time, that's not true. Like this notion that everyone has a 30-year fixed mortgage, that's not true. They have 5-year arms, they have 10-year arms. Like eventually that thesis goes away. And then life intervenes. you have kids, you move, your job moves. You don't just sit in your home because you have a low interest rate for 50 years, right? So I guess my question is, how long does this paradigm persist where it's much, much cheaper to rent than own in all of these growth cities, the southern cities, the Texas cities, the Southwest, et cetera, Florida, North Carolina, all these, it's essentially all the cities we're in. It's 40–50% more expensive to own than rent in these cities right now, like kind quality dwelling, if you will. How much longer does that persist?
Yeah, I think it's going to be a while. Now, we are going to see some adjustments, right? That right now the number of sellers is exceeding the number of prospective home buyers. If you look at the month supply data, for example, of the resale inventory in the single family market, it's beginning to approach a 5-month supply, which would typically characterize a balanced market. The other factor that's going to change this year, and this is a bit of out of consensus call, is the expectation over the next 12 months that we are going to see home price declines in most markets. Now, up till now, you markets like Houston that have seen from peak price declines of about 15% as you kind of get a resetting of expectations because housing affordability had moved so far out of line with income growth. But even with some of those home price adjustments, I think we're going to continue to see a relative advantage of renting over home buying and a lot of frustrated home buyers. As you indicated, not everyone's got the money for the down payment. When the price to income ratios really increased, and historically the home price to income ratios were around 3, they're closer to 5 today. So that is not a challenge that unwinds quickly. So some of these challenges are going to be in place for a while. It's going to help sustain multifamily rental demand. It's going to help sustain a single family rental demand, and single family built for rent is a part of the market that, particularly in the Sun Belt and markets like Phoenix, the builders have gotten into to take advantage of some of those rental conditions. But if you kind of take the step back and sort of say, what's the biggest challenge and does it go away quickly? To me, the biggest challenge is the down payment requirement. So even a home buyer, a prospective home buyer that's trying to get an FHA mortgage, 3.5% down, need a little bit more money, of course, to complete that sale. That can be quite amount of time to save up that amount of liquid savings. And so the market has really reached a situation, and it's kind of wilting now, which is why we expect to see some price decline. So I think the structural housing deficit, the housing affordability challenges are going to be challenges that are going to be with us for the next few years as builders try to grapple how to add housing supply in a market where their construction costs continue to go up.
Yeah, another thing that we're seeing on the multifamily rental side, wages have actually outpaced, they've outpaced rentals. And so the rent increases, over the last 2 or 3 years have been very nominal and sometimes flat and sometimes negative. And by the way, there's almost never negative rents in this asset class. It's very, very rare. It's happened 4 or 5 times nationally over the last 100 years. And so these are very unlikely outcomes, but they've happened. And so let's just pick a point. In the last 2.5 years, generally markets have averaged 0% rent growth. Some have been slightly up, slightly down, unchanged, but wages have been up, 3 or 4% on average?
Yeah.
And so in our asset class, in multifamily rentals, you actually have a much more affordable rent than you ever have because rent hasn't really moved, but wages have. We call it the affordability ratio. Can you talk about that a little bit? For example, Robert, I've been reading REIT earnings, apartment REIT earnings, right? That's all we do. So all I'm going to be reading about are apartments, and all of these CEOs are talking about, the improving affordability from sort of the plus or minus 30% to now it's in the mid 20s to low 20s. That's a massive move.
Yeah, and I think we will continue to see, at least in the home buying space, some marginal gains in affordability. We're probably past the peak rates, but the rental space is absolutely on a relative basis more affordable. Now, if you ask a young person, are rents too high or home prices too high, they're going to say yes.
Right.
But I agree with you. You kind of got to look at that income equation. The labor market remains solid. We do expect a bit of a rise in the unemployment rate. But if you include features like extension of the 2017 tax policies, a fairly pro-growth regulatory agenda that's moving its way through DC, and all of those macro signals would suggest that income growth is going to do fairly well in the years ahead. So, yeah, I think that's exactly right in terms of thinking about affordability conditions. They're more favorable on the rental side. They should marginally improve as long as the labor market remains solid, which most economists would say, unemployment rate below 5%, 5.5% is a really solid macro reading of the unemployment rate. That demand conditions should remain fairly healthy for multifamily real estate going forward.
I want to shift to interest rates. This webinar, in large part, is a mid-year update of the prediction article I write on behalf of Origin in Q4 of the year prior. So we have the benefit, obviously, of having a true expert here, and we're doing kind of two things at once. But when we were doing the pre-call, one of the things that I do want to change is I gave a range of the 10-year note yield, because that's really, when people talk about interest rates, sometimes they're talking about what the Fed's doing, and that's the very front of the curve. And it is important, but for long-term decisions and long-term asset pricing, which is what I'm more concerned with, and certainly our investors should be more concerned with, it's really the 10-year yield that, in my opinion, matters much, much more. And for example, the last time the Fed started cutting rates, what happened was an inverted yield curve went to a normalized yield curve. The two-year yield was higher than the 10s by 20 bips, and now it's 40 bips the other way. The 30s were flat with the 10s, now they're 40 bips across it. So we had a massive normalization of the yield curve. And so when I wrote in Q4 that I think the range will be 375 to 475. Today we're sitting, I believe today it's 4.3. Actually, I'm revising my prediction from 375 to 4 to 4 to 5. So I'm moving it up a little. I'm doing that even though in yield and down. That's my 2 cents. I think that you have is something you're comfortable talking about.
Yeah, I can talk about the long-term rates. I think, David, your connection was going in and out, but it's funny, you were talking about sort of your range of where you expected long-term interest rates. They always say for economic forecasters, the two hardest things to forecast are currency exchange rates and interest rates. We definitely had a view 12, 18 months ago that mortgage interest rates would settle in below the 4% level. That view is dead, of course. So, we're expecting right now, in terms of the 10-year, the new normal to be between 4.25 and 4.5%. For the Fed, look, the policy is absolutely increasing on the Federal Reserve to cut interest rates. You're starting to hear, particularly from Republicans in D.C., of that it's starting to look a little bit like some of the accelerated Fed cut rates at the end of 24 were politicized. The inflation data is moderate. Really, the only thing that's keeping on the Fed on the sidelines right now is some of the discussion about tariffs. But that's disconnected from those long-term rates. Those long-term rates are determined by investors and market forces, and so we think 4.25% to 4.5% is likely where we're going to be for the next few years. On mortgage rates, which of course matters for the home buying side, we think in this 6.5% to 7% range is probably where we're going to be in terms of mortgage rates, and that's going to keep the market rather similar to what we see right now. And then kind of the thinking of the challenge of the long run, I think is going to be less about monetary policy and the Fed and a lot more about the debt to GDP ratio. That's where we're watching. It's all about fiscal policy. Of course, under discussion in DC right now is the extension of the 2017 tax cuts. There's a lot of push on the Senate side in order to get more spending cuts. But that debt to GDP ratio, that's really what we think about in terms of long-term rates. And there's some good academic estimates out there that say, for every 10 percentage points you add to the debt to GDP ratio, which right now is about 100%. So if it goes from 100% to 110, you can add 25 to 30 basis points to those long-term rates. So the 10-year Treasury rate, 4.25 or 4.5, I think that's a reasonable range going forward. I don't see a lot of change. I think the market is forward-looking, so it's baked into the cake. A lot of the expectation that we're going to see some additional easing on the short end of the curve by the Fed going forward, but there is this growing uncertainty about the fiscal policy imbalances that are going to begin affecting the market if we think about the next, say, 5 years.
I'm going to let you do the bulk of the talking. And you can hear me now, correct?
Yes.
Yeah, you're going to do the bulk of the talking because my internet is a little bit weak.
Sure.
But the next thing we want to talk about are tariffs and how they're going to affect, in particular, construction in the U.S. What are your thoughts on that? Because it quickly segues into future supply, new starts. Obviously, if pricing goes up, it's harder to get new construction started.
Yeah, so, economists typically are criticized for, making broad predictions that are, sort of disproved within a couple of months or a couple of quarters. On tariffs, we got to sort of take a certain amount of humility. It's hard to predict exactly where we're going on this. My personal expectation is that we're probably navigating our way to some renewed trade deals, something that looks an awful lot like an across-the-board 10% tariff rate, which would be a pretty significant change. If you look at the average effective tariff rate for the United States in the early 2000s, it was between 1% and 2% due to the World Trade Organization, due to NAFTA, due to some of these trade agreements. So you're talking about a significant increase. I don't think the reciprocal tariffs will go into effect at any degree. And to the extent that there are exceptions, it's going to be on China, probably having something like a 35% effective rate. I think that's where we're going. All right, so we've asked builders, to what extent have you seen increases in your construction costs from your suppliers as a result of the tariff discussion? And that's broadly defined because that includes both tariffs that have been enacted, but also tariffs that are expected and the supplier is looking through in order to adjust their pricing today. What we've noticed thus far in the surveys of builders is that the impact is larger for single-family builders and it is larger for smaller contractors. So, for example, in our data, we find that about 40% of single-family builders have reported no tariff impact from their building material suppliers at all. For the other 60%, when you average it out, including effectively zeros for that 40%, the average impact on a single-family home in terms of construction costs works out to about $11,000. So it's not a lot, but it's measurable. When we've done the same thing on our multifamily survey, and this multifamily survey is done quarterly, and we ask small multifamily providers as well as the very largest, what impacts they've seen on tariffs, the impact was relatively smaller. For example, on construction costs, and it was a little harder to kind of narrow this one down, but on construction costs, on average, they were indicating a tariff effect of about 1% for construction costs thus far. So fairly small. I think that is consistent with the idea that multifamily builders typically are going to be larger. And what's going on there is larger builders tend to have long-term contracts. They're going to be susceptible to a lot less volatility in the day-to-day, say unlike a remodeler or a small contractor. So the other thing is to kind of keep in mind what countries are most likely to generate tariff impacts. We've done a lot of research on this. If you look at building material imports, 7 to 8% of building materials used in residential construction, and that's all in remodeling, single family and multifamily, 7 to 8% is imported. So it's not a lot. And then when you look at the individual countries from where those imports come from, 50% of it comes from effectively 4 countries. It's China with about 25%, another 20% to Canada and Mexico, and then the residual of that 50% is from Taiwan. And a fair amount of those Taiwanese products, like products from Vietnam, are somehow connected to the Chinese infrastructure chain. So if you're looking forward and trying to anticipate builder costs, whether it's multifamily or single family, you want to be paying attention to what's the future of trade policy going to be with the United States and Mexico. That looks like it's headed to a kind of a more positive direction that will ultimately result in, we had NAFTA, then USMCA, we'll call it USMCA 2.0. That's where we're headed. With China, I think you got to price in the idea that a 35% tariff on the fixtures and electrical components and the metal brackets, all the types of materials that tend to come from China are going to be more expensive, but it's not going to be at that 145% level that was part of the reciprocal trade agreements or the reciprocal tariff announcements. One last point on tariffs. Wood and softwood lumber is important both for multifamily and single family construction. A lot of focus on the Trump tariffs, but keep in mind that the lumber products are also subject to an anti-dumping duty process that's being run by the Department of Commerce that is completely separate from the tariff situation. In fact, those softwood lumber imports from Canada right now are currently subject to a 14% duty rate that by the end of the summer, through a bureaucratic process, not political, is going to go to 30%. So there is some risk here for the lumber market because we could potentially be facing a 30% lumber tariff with potentially a 25% tariff on Canada. I don't think that's where we're going to go, but that's the risk. And then there's a separate national security focus, like on steel and aluminum, that's just on lumber itself, that could result in another 25%. So the lumber market right now has not shown a lot of fear. I think where they're kind of looking through it. Prices over the last few weeks have gone down. They're up 10% compared to they were a year ago. But that's a good example of an individual product that could face a lot of risks. And, just kind of wrapping up thinking about the tariffs and trade, if as part of this negotiating position, we get the reciprocal tariffs fully back on force, in addition to the macro consequences it could have supply disruption effects. And that was one of the fears. If you go back 7 weeks ago, there was some concern in the industry that things like metal brackets from China were going to end up in short supply. And of course, that brings up echoes of what we experienced during COVID. So there's some potential here for cost factors. Thus far, the impacts have been fairly smaller for multifamily, but it is something we're watching as the tariff and trade discussions develop.
Yeah, we're seeing similar. I mean, because we're developing 10,000 units, so we see it in real time. That's $3 billion of development across our markets, and so we're seeing it. But the tariff impact, we're seeing 1 to 3% in terms of total construction cost increases. So it just simply isn't happening. And maybe you can speak to this, but I can as well. Because there's so few starts that have been happening in 23, 24, and current, the GCs and subs have very little bargaining power. And so there's much more leverage with capital in these deals. Do you see that, or do you monitor that as well?
We do, and that's the focus more on the labor side is a good example. So one of the things I try to track and try to estimate each month is what is the size of the construction labor, the skilled labor workforce deficit. Now, again, just like with building materials, the labor effect tends to affect the smaller builder and developer much more severely than the larger developer who's working with the same trade partners and contractors and the like. But generally speaking, if you go back a year and a half ago, we were looking at 400,000 to 500,000 open construction sector positions in the industry. Right now, that number is roughly half. It's down to about 250,000 for exactly the reason that you indicated. I know this is something you were sort of tracking over the last couple of years, which is the idea that multifamily construction took a big drop in 2025. That reduced the demand for labor. So if you ask a lot of larger developers and builders, is the skilled labor shortage a constraining issue for you right now? Their answer would be no. Now, smaller builders and contractors, yes, they will report, yeah, we're still sort of struggling to attract those workers. But, we're expecting to see a slowdown in some of the wage growth on the construction worker side, but an important wild card, which is the immigration debate and immigration enforcement. What impacts are going to have on the demand side of the market? What impacts are going to have on the supply side of the market? Just like tariffs, we don't know exactly where we're going. What I've been telling builders on the road as I travel is that if you were taking a sounding of the immigration issue back in March, if you're looking forward into, say, August, it's probably going to be triple the intensity of what you saw back then, because the scaling up of some of these immigration enforcement efforts is going to pick up. And initially, it was mostly just focused on criminal violations, some traffic stops. And of course, now you've seen in the news a lot of debate over worksite raids and the like. But, within the industry itself, in terms of working with trade partners who are not worried about the immigration type issues, I totally agree. I think it's a little easier to get access to the labor.
Yeah, let's talk about immigration for a second. What do you think those effects will be on the demand for multifamily and for sale housing?
Yeah, so one of the surprises, again, if we go back to 2019, a lot of us on the demographic analysis side were expecting population growth from immigration to number about 1 million individuals a year. And then in 21 and 22 and 23, border security really wasn't being enforced that much. And so the result was population growth was averaging about 3 million a year from immigration. It was a real tripled effect. So it raised rental demand. Now, a big change that has occurred is that border crossings are down something like 96%. I mean, they have really shut down the border. That doesn't necessarily mean you've got a smaller population of people looking for rental. And as I said before, the early data was that deportations out of the country, which would be the negative drawdown in terms of rental demand or first-time buyer demand, deportations were running roughly equivalent to what we saw in 24 and 23. I think they're going to step up, but I think we should think of this in terms of, as these programs accelerate, there's going to be a marginal impact on rental demand, but it's not going to be particularly large. There's going to be a somewhat larger effect in terms of the construction labor force. But the big thing is, if you're doing any kind of long run projections, the country is going to grow slower. It's still going to grow, right? And as we talked at the beginning, there is a housing deficit. But the population is going to continue to grow, but it's going to grow slower than it did in the post-COVID years.
I had an interesting conversation today with a professional who's a citizen, but an immigrant, first generation. And she has a lot of friends that are highly skilled, and they're very nervous about immigration policy. And what she said is, amongst that group, they were very likely to buy homes, and now they're afraid to. They don't want to buy homes because it thinks it puts them on the radar, and they're all renters now. And she was suggesting, why wouldn't you develop nice apartments in really strong school districts because this is what these people want, and they would get it through home ownership, but they can't or they're afraid to. But the problem here is these are long-term decisions for me and Origin and the company, and there's a new president every 4 years and et cetera, et cetera. But I'm just saying, like, there's lots of layers to this. Would you agree?
Yes. Oh, totally agree. And that is something that we see that the impact is going to be on that first-time buyer market. I mean, if you look at some of the regulators like Bill Pulte, who's, the regulator for the Federal Housing Finance Agency, he wants to restrict access to buyer credit for people who are undocumented in the country. So the impact on the buyer side is going to be there. But Again, I think the population is going to continue to grow. I think we're going to continue to see solid rental market conditions.
So let's ask the $1 million question. What is your opinion on AI? What's going to happen with the disruption of the labor force? Is the labor force going to reemerge with better jobs? Is it going to emerge with worse jobs or no jobs? And how does that affect rental? Because rental housing is really what we're talking about. So it always ends there.
Yeah, I mean, this is why it's funny. My team was discussing this today, just in terms of the context of what we do. How do we do surveys? We typically like to do surveys with 10-point scales. Do we move more toward a kind of a more intuitive kind of open-ended comment type survey system that we can program around AI systems? The macro effects of AI, I think, obviously we're somewhat in the hype stage, but the impacts look like they are coming. There have been good estimates by academics that I like that would suggest that something like 25% of the current office jobs are likely not to exist over the next 5 to 10 year period. Of course, when that reaches the business press, it turns into, we're going to see higher levels of structural unemployment, higher demand. I'm an economist. I don't believe that. I think of, and I think the Federal Reserve kind of has this view too, that AI is a labor augmenting technology that will have some disruption effects, but which will ultimately, in equilibrium, as capital markets get involved and as markets adjust, is going to raise labor productivity for the U.S. economy. And any increase in productivity, the closest thing you can get to a free lunch in the macroeconomy is an increase in productivity. It boosts wage growth over inflation growth. It tends to increase demand and increases demand for not just first homes, but also second homes. We tend to see a rise in whether it's condo type property demand or single family beach homes or hunting lodges. That tends to increase when you get productivity gains over a period of time. And I think it's also going to so we have to think about the nature of work itself. This is a little harder to study, but there's been some good work by, economists in the post-COVID period, that something that's more labor augmenting, that's going to make people more into the expert economy, is going to make the workforce more mobile. And what we know in terms of housing demand is a more mobile population is one that's going to be not in a particular location for a longer period of time. And that tends to favor rental housing demand. It tends to favor townhouse construction, and it tends to favor single family built for rent. So think about the impacts in the long run, whether it's a local market or a national market, in terms of productivity effects and mobility effects. And I don't think we're going to see high levels of structural unemployment. I think the U.S. economy and market economies are really good at repurposing people. And, all this is taking place in the context where we have a lot of industries where there are permanent workforce shortages. Construction is one of them. But if you think about nursing and chefs and, that kind of middle skills workforce is going to be a boon for those industries. So you're looking for, local markets that have large service sectors that are going to see an increase in housing demand as the economy evolves around what is a labor augmenting technology.
Yeah, I agree largely with what you're saying. I actually believe the first phase of AI implementation will cause more unemployment. And I think the second phase is it'll probably be mitigated by, I'll just give you an example. It used to cost a lot of money to create an app, but it's going to cost almost nothing to create an app. And so it'll unlock creativity and more businesses. Does that make sense?
It does, and one of the things that's been interesting, again, as I travel around and kind of talk to permit officials, remodelers, architects, builders, is the degree to which they can automate some of the red tape that goes into development. Whether it's a project plan or going through a permit approval process, getting government agencies more efficient by bringing in software to speed up the process. That's something that governors I talk to, certainly people in Washington, D.C., want to do to address the housing supply shortage. So I think it's not just the macro effects, but also within construction and development, we'll have the ability to move forward more quickly. Anytime you get an increase in productivity in the sector, that's going to increase demand for investment in that sector. And I think that's going to be one of the benefits for real estate.
Is there anything, Robert, and I keep getting questions about what your last name is because everyone's so impressed with you. It's Dietz, Robert Dietz.
It's Dietz, yes, that's right.
Is there anything that you want to cover? This is an open mic for you that hasn't been covered thus far, and then we're going to go into Q&A.
Yeah, it's a little adjacent to some of the topics that we were talking about, but if you're interested in real estate development, one of the areas that and again, this is a bit of an out of consensus call, so there are plenty of people who would disagree with me on it, but I think we're approaching a super cycle when it comes to remodeling. And I don't just mean single family owner occupied remodeling, but also rehab of existing multifamily properties. So we've got an aging housing stock. Particularly if you look at baby boomers who are aging in place, you've got home equity growth. Something like 10% of the housing stock that was built before 1940 is considered inadequate from a structural perspective because it's got HVAC or plumbing or structural envelope challenges. So we do see a boom coming in terms of improvement spending. That's going to help supplement, of course, some of the new construction development. But that's something to watch for because we've seen an evolution in the real estate development space of the emergence of big players in the multifamily space, of course, the national home building companies. And I think we're going to see something similar in the remodeling space, some consolidation, because that particular submarket in residential construction is ripe for new investment, new ideas, and disruption.
We're going to move into Q&A. I'm going to let you lead this. So, Robert, do you have the Q&A feature?
Yeah, I can see some of them. You want me to read a few of them and we can go back and forth on them?
Well, no, because my internet's not strong. I think you should lead it, just from a listener standpoint. If you have access to it,
yeah, I do.
You go through the questions and answer it. If you don't, I can also help, but I think it's better based on the internet. Yep.
Yeah, so we'll go back into time. I scrolled back down to some of the older questions, and it looked like there were a number of them. So the very first question that came in was, what effect will 100 bips rise in the 10-year U.S. Treasuries have on the real estate market? Look, if you're talking about a 100 basis point increase in mortgage interest rates, it would absolutely guarantee that just about every market in the country would see home price declines. And it would, we estimated that the 200 basis point increase in mortgage rate rise that we saw back in the post-COVID period priced out about 18 million prospective home buyers. Now, that's not a reduction in sales because only a certain percent of each of those people would turn into sales in a given year. But an additional 100 basis point estimates, I'm just trying to do the math in my head here, but, several million people, 5 million people or more would be additionally priced out. It would be an increase for rental housing demand if you think about the substitution effect, but it would also raise the cost of capital in the multifamily space. So I don't have particularly positive views on the for sale market where mortgage interest rates approach 8%. I think we would see significant price declines as a result. Another question, are some states such as Florida and Texas overbuilt? That's a great question. From a structural perspective, in other words, thinking about the population, the number of young adults that are living with their parents, you can think of these as potential households. I would argue, no, they're not. In fact, they continue to be underbuilt relative to the demographics. The challenge with Texas is the supply elasticity is larger. So as mortgage rates remained high, builders are adding relatively more supply on a per capita basis. And so the market is necessarily taking a breather. And so you have a decline in things like Houston house prices. A lot of spec home building is pulling back to kind of let the market digest some of the additional inventory. Florida is kind of a unique situation. You do have issues, and we didn't talk about them yet at all in terms of like insurance costs. In fact, so the worst performing state in the country in terms of building conditions and home price gains has been Louisiana, right between your question of Florida and Texas. And a lot of that is due to insurance issues as well as some governance issues. But Florida's inventory challenges are really concentrated in the for sale condo market. If you think about new development, 95% of multifamily construction starts are built for rent. That's right now. Historically, it was 80%. So there's really not much that 20% that would have been built for sale condo right now is down around 5%, and it's concentrated just in a few markets. So what we're seeing is a rise in the inventory levels of those condo properties. It's strongly connected to the need for reinvestment, higher HOA fees, and some of the legislative changes that you've seen taking place in Florida. That said, Florida pricing does need a reset or a breather to allow for income growth to catch up. And so I do think we're going to see some slowing. And keep in mind, from a builder perspective, not the resale market, the Case-Shiller index, but from a builder perspective, builder pricing nationally is down 8% from peak. We haven't made a big deal about it in the media, but you've got in any given month, roughly a quarter or more of home builders who are cutting prices in order to induce sales. In fact, in the last estimate that we did, 37% of home builders in the late May, early June period were cutting prices. So the resale market's essentially got to catch up with where the new construction price is. The third question, how will deportation of 1 million immigrants affect rental demand and labor to build housing? So we've done some work on this. You said 1 million, that I think is sort of the administration's target for an annual total deportations. So 300,000 individuals in rental demand, cut that in half for household size is about 150,000. It's measurable, but it's not a huge effect. Whether or not the system can sustain 1 million deportations a year without a big increase in budget authority, and there is some additional funding authority in the tax bill that's moving its way through Congress, I think that's kind of an open question. We have done some research on the impact on labor supply and construction development. And without walking you through all the algebra, basically, if you are assuming about 1 million people and they're uniformly distributed across individual labor sectors for 1 million for deportations, it could have an impact of reducing housing starts by 10 to 30,000 units. We're in a 1.4 million housing starts environment. So that's, again, measurable, but not a huge effect. But it is something to watch as we go forward, depending on how aggressive the system gets. Let's see. Some of these others are just comments that we addressed as we went through. All right, the next one is, what is the impact of immigration on the cost and availability of construction labor? So, we basically just already asked that. I will give you some background data on this that we didn't talk about. We've done research in the last few years trying to estimate what is the share of the construction labor force, and this is all in, non-residential and residential, that is non-native born. In other words, born in another country. It's roughly about a third. Now, you've got some sectors, like sectors in agriculture, where the industry's labor force is 60 to 80% non-native born. So construction is one of the top ones. It's not the top, but it's significant in terms of an exposure to policy risk. Now, the sort of the following question then is, what share of the industry's workforce, and here we're not talking necessarily at the builder level, but down at the subcontractor level, what share is undocumented or illegal. Now, we know they exist. We know it happens. The estimates and the data are not particularly good, but the best estimates, the one I typically will rely on, is something like 15% of the industry being undocumented, which again is measurable, but not at the top of the charts. Things like meat processing or some of these agricultural areas or the hotel industry. So 15% residential construction labor force, all in, is probably about 4 million people. So you're talking about several 100,000 people as an exposure. If we go back to the earlier question of a deportation total goal of 1 million, and there's roughly about 15 million illegal immigrants in the country, you're talking about 1/15. So here, do the algebra. A fully phased in deportation program and its impact on construction labor supply could be tens of thousands of workers. Again, that's a small percentage of the effect. I think the larger effect, and it's going to be one that we're going to be trying to measure in the weeks ahead, is the degree of people not showing up to work because of fear of enforcement. The evidence on that is anecdotal. It's somewhat mixed. I actually did an interview with NPR where I noted that when we see worksite raids, and I kind of follow up a little bit later, the impact lasts for a couple of weeks. And so we're going to see a rising share, particularly in single family construction, of work sites that basically go on pause while subcontractors aren't available. And then after a few weeks, they'll go back online. So I think what you're hearing from me is that an expectation enforcement's going to increase. There is an exposure element to it, but a lot of these factors really is going to depend on the scale of a program. And I think ultimately there are limits, whether it's judicial system, facilitation, even political pressure, as we've seen in Los Angeles, in terms of how far some of these programs can necessarily go. Next question. Will readily available AI tools democratize the proprietary information we have from the Origin analytics tool will diminish our advantage? David, I'm going to leave that one to you.
Yeah, I can answer that. The answer is no in the short run. In the longer run, 3 to 5 to 10 years, yes. I think that all existing technology is disruptible, including ours. But I think it's a short-term, 1 to 5 year advantage. Go ahead.
Yeah, so next one, concerning population growth in the Sun Belt states, what industries, occupations are deriving higher paying jobs for those that would occupy Class A rental properties? Any examples? That may be a little too granular for me. I will give you, as we've looked at the Southeast, what's been surprising over the last 20 years or so is the degree to which manufacturing activity really has helped support growth. I'm a Midwesterner. You mentioned Ohio State at the beginning. I'm originally from Ohio. The Rust Belt has lost some of that momentum to the Sun Belt. So if there is really going to be a sustained focus on manufacturing activity, I would expect the Sun Belt to benefit. But then you also have to throw in the service economy. So health services, education services, a lot of pickup of an activity that would benefit. So whether it's student housing, a more mobile population, downsizing seniors, I think all of that in terms of the trend growth of the Sun Belt is going to help rental demand going forward. And next one is, how will the 10-year Treasury rate staying elevated affect multifamily values? Well, unfortunately, that's one that we don't try to forecast. Generally speaking, you would expect property price growth to be somewhat lower just because of a higher 10-year Treasury rate. David, I don't know if you have any individual comments on that one.
I mean, the 10-year note yield's been in a range, kind of 4 to 4.7 for the last year. We're right in the middle of it. So the question is making a presumption that they go higher. We don't know that. They could stay the same or go down. I think you covered before, the rate going up is bad for all asset pricing. So like, in other words, if you're concerned about this, you probably shouldn't be in the stock market either. You shouldn't be in private equity. You shouldn't be in assets in general. But I love our fundamentals. I don't know where the 10-year note yield is going.
Yeah, great answer. I agree with that. And then the last question we've got, as population growth and birth rates continue to decline, and that's a supposition. I'll mention that as part of my answer. How much longer do we continue to see the structural undersupply of housing? Are we at 10, 20, or 30 years out? So I think the structural housing deficit is a 5 to 10 year issue. So our expectation is, whether it's single family or multifamily construction, because we're kind of agnostic, we're just trying to estimate households and population getting into housing units. And again, we think it's about 1 million. There are other groups out there that think the housing deficit is 4 million or higher. I personally think those estimates are way too large. The way that we get ours is by looking at vacancy rates for rental housing and owner-occupied housing, which are diminished today, and saying how much housing will we have to add to get those vacancy rates to return to their historic norms. And then that answer works out to about 1 million, 1.5 million. So we think this is kind of a 10-year structural problem, 5 to 10 years. It's not a 20 to 30 year issue. And the big thing that's going to change, and you look at the demographic tables, there's a lot of millennials, right? I'm a Gen Xer. There's not a lot of Gen Xers, a lot of millennials. That provides a really good runway for home building growth and activity over the next 10 years. Then as you get into Gen Z, Gen Z's front end is a little bit larger, but then the back end of Gen Z falls off a lot. There's just not a lot of individuals. And then when you get down to Generation Alpha, which is today's 12-year-olds and younger, it's a lot smaller generation. So a lot of economists expect a decline in household formations by the time you get into 2035. That's going to affect, the single family market. It's going to affect growth in some of the areas. But to your question of birth rates continue to decline, do we think birth rates are going to decline? The fertility rate in the United States is 1.7. It needs to be 2.05. And we've done some surveys that indicate as housing affordability increases, as it moves in a more positive direction, and we think that's coming, and we talked about the reasons earlier in this seminar, as housing affordability conditions improve, the fertility rate should actually tick up a little bit. Now, I don't think it's going to see a dramatic change, but then as you get more households with one child, they're going to be looking for a slightly larger apartment or for a townhouse. And so we think that's coming by the mid-2030s. If you look at the back end of the 2030s, there is some structural decline. In fact, as Gen Beta, which has got to be the worst generation name I've ever heard, Gen Beta, that comes after households, it sounds like a generation of losers. They'll have to create a millennial moniker for that. But as Gen Beta begins to be born in the next few years, it'll be really interesting to see if it reverses some of the decline in Gen Alpha. And again, that's one of the things we're watching. Population growth rates combined with the movement of the population will always create an underlying demand for housing. But the big change that's going to come and support the market, even as those population growth rates decline, is replacing the older stock. And we'll see that in single family construction. We'll see it in multifamily. Tear down construction is 10% of single family home building right now. That share is going to go up, and we're going to see the same kind of trends in the multifamily market. And that was the last question. So, David, I'll turn it back over to you.
You did an amazing job. Thank you for carrying the water. Based on my internet, we had the right guest, Dr. Robert Dietz. Thank you so much. Thank the audience for their time, and we'd love to have you back on again. I'd actually like to make this annual. You're very impressive, and I enjoyed the conversation a lot. Everybody have a great day, and we'll talk very soon. Bye-bye.